Welcome to Zitron Squeeze, where today the AI boom's balance sheet gets stress tested. The core question here isn't whether people want AI, it's whether the biggest AI company can sell more of it without losing even more money. And if the answer is no, that problem doesn't stay inside one startup. It leaks into cloud giants, chip vendors, lenders, and a whole lot of investor storytelling. Start with the plainest claim in the pile. OpenAI reportedly lost $20.9 billion on $13.7 billion of revenue in 2025, and its Q1 2026 non-GAAP operating margin was said to be negative 122%. If those numbers are even directionally right, the bullish response of revenue is growing fast, only gets you so far. Growth helps if unit economics improve with scale. The criticism here is that OpenAI may not have that kind of scale advantage. The argument is simple and pretty hard to wave away. More usage means more tokens served. More tokens served means more compute. If compute is the dominant cost, then growth can expand losses unless pricing outruns infrastructure spend. That does not prove the business is doomed. Costs can fall with better models, custom chips, smarter routing, and higher-value enterprise products. But the burden of proof is now on that story because the reported losses are so large. The most jarring part is the projected pivot from negative $51 billion in free cash flow in 2029 to positive $39 billion in 2030. That's not a normal ramp, that's an almost overnight transformation from burning cash at industrial scale to printing it. Could that happen? In theory, yes. If pricing power jumps, costs collapse, and product mix shifts fast. Is there evidence here that all three are lined up? Not really. Then there's the liability side. The allegation is more than $800 billion in compute commitments through 2030, with at least $146 billion due by the end of 2027, spread across Microsoft, Google, Amazon, Oracle, CoreWeave, Broadcom, and Cerebras. Even if some of that is flexible, renegotiable, or contingent, the scale matters because it changes how we read the whole AI infrastructure market. OpenAI stops looking like just a customer and starts looking like a pillar supporting other companies' growth narratives. That's the circularity concern. Investors fund OpenAI. OpenAI prepays or commits to hyperscalers and hardware providers. Those providers then get to point to booming AI demand. If a meaningful chunk of that demand depends on continued fundraising rather than self-sustaining margins, the ecosystem is less sturdy than headline revenue suggests. That's not the same as saying the demand is fake. Enterprises and consumers clearly use these systems. The issue is whether the spending level is economically justified today or temporarily financed into existence ahead of proven returns. The funding question is where the story gets less philosophical and more mechanical. If OpenAI really needs $100 billion to $200 billion almost every year until profitability, then this becomes a constant refinancing exercise, not a normal growth company cadence. And the latest round matters for what it implies. If $110 billion of a $122 billion raise came from Amazon, Nvidia, and SoftBank, with only $12 billion from the broader field, that suggests the investor base may already be narrower than the valuation headlines imply. Each of those backers has reasons to care that go beyond pure financial return. Amazon wants cloud demand, Nvidia wants GPU demand, SoftBank wants exposure to the AI upside story. Strategic motivation can be real support, but it can also obscure whether the asset clears a tougher market test. The pressure point is whether fresh outside capital keeps showing up once the valuation is already in the high hundreds of billions, and the path to profitability still relies on cost assumptions that haven't been demonstrated. A lot of the optimism is expressed through annualized revenue run rates, and the critique here is fair. Those numbers are often marketing tools before they are accounting tools. If a company takes a strong recent 4-week stretch and multiplies by 12, you can get a dramatic headline from a product launch, a temporary usage spike, or one large enterprise push. That does not automatically describe durable recurring revenue. With AI, that distinction matters more than usual because usage and cost can rise together. A software company adding more users usually likes that sentence. An AI company may be adding revenue and variable cost at the same time. So when OpenAI reportedly moves from above $20 billion annualized in late 2025 to $25 billion in March 2026 and around $40 billion by August, or Anthropic gets quoted anywhere from $65 billion to more than $74 billion, the first question should be how those figures were derived. Without that context, the numbers can support almost any narrative: unstoppable growth, slowing momentum, or strategic cherry-picking. The Anthropic angle is less about one company winning and more about relative comparability. If Anthropic reaches public markets first and presents itself as the cleaner enterprise AI story, that could make OpenAI's valuation demands harder to sustain. The source argues Anthropic looks healthier because it has faster growth, more enterprise concentration, and fewer side bets like browsers, video, and devices. That may be directionally true, but it doesn't make Anthropic healthy by default. The stronger criticism is aimed at coverage that values these companies on future cost efficiencies that could happen, while downplaying current losses that definitely are happening. Forecasted efficiency gains might arrive. They also might arrive too slowly to justify today's capital structure. So if OpenAI wants something like a $1 trillion IPO story, while private investors are already near that neighborhood, the challenge is obvious. Public markets usually want either proven earnings power or a very credible bridge to it. Hype can help the first leg of the trip, but it's not the whole bridge. The collapse scenario described here is not one dramatic day where everyone suddenly realizes AI is over. It's a cash flow sequence. First, a revenue miss or visible slowdown, then investor nerves, then a funding gap, then the decisive moment when a supplier wants actual cash instead of extensions, equity, or optimism. That's why CoreWeave and Cerebras are framed as useful stress indicators. If one customer represents a huge share of your revenue, rising top-line numbers can still hide deteriorating cash collection. The possible endgames are worth separating. Microsoft absorbing OpenAI is very different from an uncontrolled default. One is a messy restructuring inside a giant platform. The other could ripple through cloud guidance, supplier solvency, venture portfolios, and customer access. A merger with Anthropic sounds superficially elegant because it combines narratives, talent, and investor hope. Economically, though, combining two expensive model businesses does not automatically fix either cost structure. That skepticism is well supported. The biggest claim is that this is a systemic AI bubble risk, not just an OpenAI risk. That depends on how much future cloud and chip demand is truly anchored by OpenAI-style spending and how replaceable that demand would be if one buyer faltered. The source may be right that people too easily assume rich investors and giant companies must have some master plan. Sometimes there is no hidden stabilizer. Sometimes everyone is making an aggressive bet at once because the alternative is missing the platform shift. What's well supported here is narrower, but still serious. Annualized revenue headlines are not enough. Extreme projected profit inflections deserve skepticism, and large compute commitments can turn a company's financing risk into an ecosystem risk. What remains uncertain is scale. We do not know whether efficiency gains, enterprise pricing, or strategic support will be enough to carry these businesses through. But the possibility of failure is material enough that dismissing it as anti-AI panic would be lazy analysis. That's the squeeze for today. If the AI story is going to hold, it has to hold on cash flow, not vibes. Thanks for listening to Zitron Squeeze. This episode was generated by Podkey. Create your own at podkey.fm.